If the market is hot and if you're getting it cheap, that means that there is something wrong with the house, right?
Anything can be positive cash flow depending how you leverage it.
Majority of the times when people buy investment properties, they start imagining themselves living in it. I also feel that people who are local to the area have a bias towards a lot of the areas that they're living in, right?
As property prices increase, the yields compress.
I truly believe that local knowledge is important and it's valuable, and the property buying is art and a science. Hello and welcome to another episode of Help Me Buy Property Podcast. In today's podcast, we're talking about the property trifecta. We're talking about what is this holy grail that everyone talks about: the growth, the positive cash flow, and the instant equity. Now, can we achieve all of this together? Is this holy grail actually achievable, or is it just a pipe dream? In order to have a much deeper connection or a deeper discussion about this particular topic, I have Lloyd Edge from Oz Property Professionals. He hosts his own podcast called Positively Geared, a seasoned property strategist, and we'll unpack this together. Lloyd, welcome to the show. How are you today?
Mox, doing very well and really nice to be here.
And look, you have been the host, so how does it feel, sitting at the other side of the chair today?
Not loving it, and looking forward to it and seeing what we can unpack.
Amazing. So let's get right into this. Let's talk about the property trifecta. Is it actually possible to get the capital growth, the cash flow, the instant equity all in one in a single property, or is it just a dream that everyone talks about?
It's definitely possible, but it's certainly something that is, it's not the most achievable, most easy thing. But let's just break that down a little bit. Obviously, capital growth is something that everyone's trying to achieve in property over the long term, getting that organic growth, and then people are looking for a bit of cash flow as well. When we try to put them both together, there's often that argument that if you're getting high growth, you're going to get low yield, or if we're going to get a high yield, you get low growth. So you need to try to balance that, which often means going out of maybe the major blue chip capital cities, getting into some of the outer suburbs or the regional markets to be able to try to get both, because we don't want to just one or the other. I do believe that if we're going to get high yield, we also want to get some good growth on the property. So buying a property with those good fundamentals as well. But when it comes down to the instant equity, different people have different understandings of that. A lot of people think that if you just buy a property under market value, then you're getting some instant equity straight away. However, that's quite difficult to do, getting something under market value, particularly if you're in one of the hot markets, around the country at the moment. And I think one of the things that people need to also be aware of, that market value itself is something that is a bit of a myth, because on whatever property sells for on the day is actually the market value. So buying something perceived under market value is not really as straightforward as what people are trying to make out, because they're really setting that market value on the day. So what I look at for instant equity is how we can actually add value to that property. Now, therefore it's kind of not instant, as in you got that equity right away, but it's going to be a lot quicker than just waiting for the organic growth only. So how do we add equity? So adding instant equity could be through a renovation. So let's start with, say, a cosmetic renovation, where we look at doing some painting, some flooring, some window coverings, updating the kitchen and the bathroom, some landscaping. Now that can be adding some instant equity there. I usually recommend that you spend about 5 to 7% of a property's purchase price on the renovation. If you want to go into a little bit more detail, you might be able to add another room. If you add an extension, that might take some council activities as well. So you need to be aware of that. So that's one way of adding that instant equity, and that's definitely doable. And potentially buying a property that's on a larger block that you can subdivide, then you're actually adding equity there by creating a second block. So that's doable, or maybe building a duplex and subdividing them. Those kind of options are where we are looking at picking up that instant equity, and they're certainly doable under the right circumstances.
And so when you talk about instant equity, is there a rule in place where, let's say, if you're spending 5 to 7% towards the property price, towards renovating, what sort of uplift do you expect? Do you expect 10% or 15%, 20%? Is there a rule of thumb in, what is the X amount of profit or the manufacturer returns that you should expect. Because if it's like for like, if you're spending like $30,000 or $50,000 and your equity uplift is $50,000, would you rather not just go out there and buy that property, right? It's not so much of an equity uplift, right? So yeah.
What I try, I guess there's no real rule of thumb because it does depend on what's in the market. You really need to understand the market well. Like essentially, if you're buying a property for say 500,000, and then you ascertain what it's going to take to get work done, and it's going to cost you 50,000 to do it, but you can see that in the market, similar properties that have been renovated are selling for 700. Then you've got, you're going to get that. It's an equity of maybe 150,000 there. But what I like to look at is to try to see if I can get $3 back for every $1 I spend on a renovation. Now, you got to be a little bit careful of that, of course, because if you get trades in to do the work that's going to become more expensive and you don't want to blow the budget, and that's something you got to be very careful of from that aspect. But certainly, if I'm doing a renovation, that's probably the figure I'm looking for. Spend 50,000, I want to get 150,000 back on the renovation. If I'm doing a development, which I do quite a lot in my portfolio and with some of the clients I work with, we want to be making a return on that investment, which somewhere between the 15 to 20% mark. Back in the good old days prior to COVID, it was a lot higher percentage mark than that, but it is much harder these days to get a really good return from those type of developments, but it's certainly possible to still get a return. So we're looking at a percentage of maybe 15 or 20% on the cost of the whole development.
Cool. Nice. And if I take a step back and talk a bit about the property trifecta, and talk about the dream, what are some of the biggest mistakes that you see people make in this space when they're trying to chase the growth and the cash flow and the manufacturer returns together?
Yeah, so I guess firstly, people do make the mistake of overcapitalizing. So they will buy a property, they want to renovate it, but then they get a little bit emotional about it, and then decide that they want to, and you add this and add that, and it doesn't really do that much for the property. So you really need to understand the demographic. What does the property in that area actually need to be right for the market? You don't want to be putting in a brand new kitchen, brand new bathroom because you think that's what adds the most value to your property, when in that area, maybe they don't really need that. So you really need to understand what's, where you should be spending your money, because overcapitalizing can be an issue. And also getting a little bit emotional. Maybe you're buying in an area where, the families living in properties are happy with laminate bench tops in their kitchen, but you're wanting to put in a 40 mil stone bench top, which is going to be a lot more expensive. Then that's, that could be a bit of an issue as well. Yeah. In terms of other factors there, sometimes people try to chase really, really high yields and get that positive cash flow. But then that's going to be really hard to necessarily get the strong capital growth, because people start looking at towns that are very regional, that don't have a lot of growth drivers, or maybe mining towns that just have like a one industry town essentially. So that's definitely a mistake that people make sometimes when they're looking for, really high yield.
Yeah. And it's interesting, right? Majority of the times when people buy investment properties, they start imagining themselves living in it. And so, of course, here all of these times where people will be like, oh, I wouldn't live in a property like this. And so naturally, it's the emotion driving the investment decision, whereas emotion should be there for the enjoyment and not so much driving the logic, should be driving the investment decisions, right? So
it's so true. I had this conversation with someone the other day where I actually said that out of all the properties I've ever bought, certainly for myself and probably for anybody, there's only ever two properties I've ever liked. So I thought, is our home that we live in, which is essentially our dream home, and our holiday home. Everything else, it's all about how that property can help me with my long-term goals. Does the brief, is it a good investment grade property? Is it going to achieve the growth, or do I think it's going to achieve the growth? Is it going to have that cash flow that I'm looking for, and so on? So many people do get emotional, about their properties. You really need to take the emotion away from that, because while you may not want to live in it, as long as it's the type of property and it is suitable for the wider population in that area to live in, because a lot of the times you may not want to live in it, but they're also in a suburb that your property not planning to ever live in.
100%.
It's all about the numbers for you, right? It's about wealth creation.
Yeah. And it's also about the price discrepancy, right? You are basically looking for areas of opportunities where a schmick looking brand new house is selling for an X amount. And, if you can bring that old house into a much nicer, warm looking presence, then people would start appreciating and start paying more. It's always about what does the person walking through the house is ready to pay. You're basically attracting the owner occupied demand, right? I have this, mental note, and every time I'm going out there, looking for a property, is about I want the house that everyone wants, and I want it at a fair price, right? There is no such thing as, I'm going to buy it at a cheaper price right now, right? Because if the market is hot and if you're getting it cheap, that means that there is something wrong with the house, right? Especially if the house is on the market and everyone has access to it and no one wants it, and you think that you've got it at a cheaper price, and yes, the bank values it higher because of the AVM and the way the logic works, know this for a fact that whenever you're going to sell that property, no one would want it, right? Because when you were buying it, no one was wanting it, right? So things don't change materially, right? So a lot of people don't think about it, that sort of
That's
logic.
really true, because one of the things that you need to look at is, how can I dispose of this asset, so to speak? So, is this probably going to be something that I can sell easily in the end, when I'm wanting to get rid of it? Because when you look at properties, like one of the things that when you need to look at is buying on a nice quiet street, for example. You don't want to be buying on a busy road, opposite a roundabout and all those things, or buying in a flood zone. When the property is really hot, when the market's really hot, just about anything will sell themselves, essentially. But what you want to do is you want to buy a property that's actually going to be in demand when the market is really cool. And from my experience, when the market cools down, those properties that are not well located, they're in a bad area, they're on a busy road, they're not going to be in demand. But if you're buying in a really good investment grade location, those are the properties that are going to be in demand, even when the market cools down. So that's what you want. Now, for me, particularly if you're buying on a bit of a budget, which which I often have at times, it's not always about buying the most beautiful property, because sometimes I might be buying something that's a bit older and run down. But for me, it's about also adding value, because if you can buy like an older property and there you are adding that value through a renovation, getting that instant equity, then you're building that property up to scratch. Anyway, but what you're saying is really important, is that if a property's been sitting on the market for ages and no one wants it, then there's probably a few red flags there. It's the same with a lot of off-market properties. Like all buyers agents and things get access to off-market properties, but it is something that people need to be aware of, that just because it's off-market doesn't make it a good property. Quite often, they can be overpriced, the vendor wants too much, or there might be something wrong with them, and that's why the vendors or the agents trying to flub it off-market. So we'll be aware of all that as well.
Don't get yourself taken on a ride by property spookers, so-called property investment advisors, or buyer's agents who are selling house and land packages or off-the-plan properties or apartments. Get yourself a copy of this book called The Millennial's Guide to Property Investing. This book is not just for millennials. The title suggests, but it's actually the most advanced way of investing in property. This book will relate to your clients, your colleagues, and other business owners. There are so many property spookers out there who have come out of the woodwork over the last 3 to 5 years. And there is so much misinformation out there that I had to write a book about all the F-ups that people can actually avoid in order to be super successful in the property investment journey. Some of these are really easy to identify, but they are so costly to fix once these mistakes are made. So it's a short book, it's easy to read, it has a lot of stories, it has a lot of examples, and it is a true guide for people who wants to do it themselves. My name is Moxin Reza. This is my story, and a lot of you will relate to parts of this story if you're not born in the riches, and if you're trying to build a property portfolio that can last generations and help you improve your lifestyle along the way. So I give you a chance to come out there and have a read. Be kind, stay safe, keep smiling, keep investing, and please do check out the book.
I have this saying that, I would rather overpay for a house that everyone wants than underpay for a house that no one wants, because ultimately that is the price that, people would ultimately pay for it, right? Because there is so much activity, right? Then, think about it logically this way, that, if there are 30 people interested in a particular house and I get that property, there are 29 of these who would try looking for a similar property, and they would always go out there, and even if they pay like $1,000 extra, there's 39 people or 29 people who would go out there paying extra $29,000, and that's the instant growth that you're looking for, right? So it's important to think about some of these things as to the interest for the buyers and the owner occupiers could be very different in different markets. And I completely agree and understand that you need to basically find that niche where owner occupiers are not only driving the price growth, but also the rent growth. And that takes me to the next question, which is, let's say, and I'm going to throw a curveball here. Let's say if you had $750,000 to start off today, and if you're trying to basically bring all of these three trifecta together, where would you start? Which state or which suburb or which LGA would you start?
For me, at the very present time in the markets, I think in terms of getting all three of those, Queensland is definitely a market that that I like and that's doing well. So we can break that down a little bit. I buy a lot of properties, and I've got properties in my portfolio across other states, obviously New South Wales and Victoria and stuff. Yields are lower in Victoria, so great markets to buy in Melbourne for lots of reasons. But if you're looking for the trifecta, then you're not really going to get that that positive cash flow or anything in the Melbourne market. The yields in New South Wales are a little bit higher than in Melbourne, but some of the regional markets in Queensland and particularly Southeast Queensland, work really well. But when you do a deep dive more into some of the stats, I read a stat a couple of weeks ago where 40,000 people had moved out of Sydney in the last financial year, and the majority of them, over 3/4 of them, actually moved to Queensland. So there's a big internal migration to Queensland, and there has been for many years. What we're seeing there is that the government is not anywhere near reaching their housing targets. So we've got an undersupply of housing. We've got huge population growth, therefore a high demand for housing. The market, there's just so much potential for capital growth there. And then, if we're talking about Brisbane and even Southeast Queensland in general, we've done quite a bit of research into how the Brisbane Olympics are going to affect that market as well. And it's really interesting to see what's going on there. And we're seeing a lot of growth there, but I think it's sustainable growth. While all markets will go through their cycles and things, I think long-term wise, it's definitely Brisbane and Queensland's turn. And I think we're seeing some really good yields. Like Brisbane itself has fairly strong yields in comparison, certainly to Sydney and Melbourne. But if you go to some of the regional markets, places like Bundaberg, Rockhampton, Toowoomba, different types of areas, solid yields. We can certainly get some a combination of that growth and that cash flow, because we're seeing that growth and we're getting some good yields in those markets as well.
Yeah. And it's quite interesting. I think, some of these markets have been growing for quite some time and they're staggered. And this is the second wave of growth that you're seeing through Toowoomba and Bundaberg. I remember us buying in Bundaberg all the way back in 2017, 18 as well, where there was a bit of growth cycle that came through post-COVID. And then, this is the second growth cycle that is coming through Bundaberg. Of course, we're talking about LGAs, but, suburbs play a really important part. And so, for you viewers and listeners, you need to be really, really careful as to where you are talking about and where you're buying in, because a neighboring suburb could be a good suburb versus the suburb that you might be looking for could be a bad suburb. So what are the key things for busy professionals for them to spot a property that could achieve a trifecta? Like, what are the key the lead indicators that they should be looking at if they're trying to find a trifecta?
Yeah, so I think one of the first things we really need to look at in property is do a lot of research on the area in terms of what infrastructure is going in, what sort of growth potential is going on there. But in terms of getting some organic capital growth and demand for rental, we need to look at the population increase into that area, into that suburb, and we need to look at things like the days in the market. And if that's falling, we can see that it's starting to become a market that's really started to grow. Because I like to I still like to sort of use the term property clock. A lot of people don't necessarily use that term, but I still like to get into a growing market. So if I still see that we're at 8 or 9 o'clock on the clock and there's still more growth to come, I like to get into those sort of areas. But it's really important to understand the markets really well. So we've both sort of mentioned Bundaberg a little bit. So if you look at that area, you really need to understand that like a local. So do some research, but then speak to local agents, probably real estate agents who are not selling a property that you're interested in, of course. So you can try to get some transparent advice there, or speak to a local expert or that's independent or something like that. But as an example, if you most of the area is pretty good in terms of not being in flood zones, but lots of Bundaberg South and a little bit of Bundaberg East are in flood zones. So you need to be, and if they're not in flood zones, there's a few flood overlays, so you need to be careful of that. So it's not just it's not all around Bundaberg. So you just need to know the streets well, because some some streets are obviously better than others. You need to know and get a good understanding of where the flood levels were at the 2013 floods, and because a lot of that's prevalent and can be an issue with insurance. I mean, Ipswich in Brisbane is an example where on some of the contracts there, they still refer to the flood level of the 1974 floods. So generally you've got to be very careful if you're buying in that area, because it's very much a floodplain. So you would need to have that sort of local research, because if you buy in areas that are in a flood zone, that's going to increase insurance costs. It's going to be harder to sell the property in the future, and that's also then going to inhibit that capital growth and demand for tenants. So therefore, the whole trifecta thing you're trying to get is going to be harder to achieve. So really having decent research on those areas is very important.
And with the market and the dynamics changing quite significantly, do you feel that a lot of this trifecta is going to be harder, or is it easier? If you talk about the 5 years outlook or the 10 years outlook, you hear people talk a lot about you can chase either growth or either yield, and both of them cannot come in together. With the way the wage growth is happening, do you think that the yields are going to stabilize while the prices keep rising, and investors would be in a position where, hey, there is no more positively geared properties and everything is about growth and manufactured returns?
Yeah, look, that's really interesting point and question. It is getting harder. So it's certainly not something that we can sit here and say, yeah, it's getting easy. It's easy to find this. It's very close to impossible to find a true positive cash flow property at the moment. The caveat of that, of course, is that anything can be positive cash flow depending how you leverage it. Like if you done a 50% deposit, then it's going to be positive. Most people will go at 80% or 90% lending. That's not positive cash flow. As property prices increase, the yields compress. Now we've seen that in a lot of markets. We've been seeing that in Brisbane for a few years now, and things. And we've even seen that in Perth, because Perth had one of the highest yields, pretty much the highest yields of any capital city behind Darwin. But the yields have been compressing a bit in Perth as the markets have been increasing. What we're still seeing in some of the Queensland markets still is that the yields are still keeping up at the moment because there's so much demand for rent. Of course, one thing about that is you can only increase the rent once each calendar year, or once each year since it was last increased. So the market might be moving along, but it doesn't mean you can increase your rent until down the track sort of thing. But I also think that long term wise, potentially the yields are going to probably stabilize or even compress a little bit in a lot of those markets as well. So investors need to be aware of that and keep in mind that yields are not the only thing. We still should be really looking at growth. If you do a renovation to add value, add equity, that can also add cash flow, so that can actually improve the yield on the property perhaps. And of course, something that I love doing when we can is getting a dual income property, because that will obviously help the cash flow if we get something that is a duplex,
Definitely,
or a house with a granny flat. That kind of scenario.
Yeah. So there's a few things that I want to unpack. One is more in relation to finding the trifecta. So one of the key things or cool things that you can do is look for properties in areas where the rental yields are high, but the property has been locked into a low rental, right? And of course, the trifecta might not work when you're acquiring the property, but you would get an opportunity to, increase the rent and, make it positively geared, provided that, you're finding those discrepancies. You would find them a lot of the times where you would realize that a particular property in a suburb is way out of sync, from the normal rentals, because, the old investor had no idea as to where the rentals are sitting. So it's important to understand and cash out on some of these things. The second thing, which is quite important from my perspective, is while I truly believe that local knowledge is important and it's valuable, and the property buying is art and a science, I also feel that people who are local to the area have a bias towards a lot of the areas that they're living in, right? And I'll give you an example, like Sydney, right? when you talk about urban or you talk about Bankstown, you talk about Punchbowl, right? There was a lot of negative connotation attached to it. Like, there were properties selling for like 600, 650 there, and no one would touch with a 10-foot pole. And you look at Punchbowl now and it's going through the roof, or Greenacre now it's flying through the roof right now, right? And so, and same with, like, I can talk about Melbourne, you talk about Adelaide, like Elizabeth and the Salisburys, of Elizabeth, or Morford Wells of Elizabeth. Or when you talk about Queensland, there's, south of Queensland where Logan people were always sort of, or MBC, Moreton Council, people were like, oh, I don't want to basically, go and live there. So it's always about looking at those areas where the gentrification is happening, and the locals don't feel that the areas are gentrifying because they've been living there for so long. And Melbourne, again, is a typical example. You look at West Footscray and Maidstone and Braybrook and all of these areas which are massively going through gentrification. Whereas if you talk to a local, they'll talk the crap about the area, and they'll be like, oh, I wouldn't invest there. And so it's always interesting that, while local knowledge is important, you need to always also add a bit of salt to what they're saying, because they might be biased because they've been living there for 10 years and they don't see the gentrification.
That's such a good point. Like, I really agree with that. That reminds me of one time, a few years ago, where I was talking to someone about, I'm going to go and buy property in Newcastle, and that person was from Newcastle, but I'd never buy Newcastle. Oh, it's just a terrible place to buy. But
yes,
Newcastle, for many years, it was one of the best places to buy. I mean, I bought a lot of properties there, and I built duplexes there, and they did crazy things. Like, did really, really well. But yeah, look, your point around like Elizabeth, obviously in Adelaide, Logan, and obviously we've got places in Sydney. Oh, you mentioned like Greenacre, but then we've got places out west, like Mount Druitt, Shelby, those kind of areas. Like that's all. Like, I really agree with that, because a lot of the locals will always be sort of you're looking at that stigma and not seeing that gentrification around that. I guess as a non-local, though, when you're looking at those sort of areas to potentially invest in, you need to obviously be looking at, and the crime rates and the amount of housing commission that might be there.
100%.
You got a place like Logan that I think from the last stats I checked had about 51% renters. My stats as an investor is to buy where there's about 70 to 71% owner occupiers in an area. So that actually, for me, it's about actually buying in Logan, essentially. So I think as an outsider, I mean, when I say local knowledge, I mean, I think that that was certainly, if you're an outsider trying to invest in a market that you're not familiar with, speaking to locals is just good to get a bit of an idea. If you're, maybe like a buyer's agent buying in those markets, then obviously get to know that market really well if you're not necessarily a local in that area.
And I completely agree with all of that, because I think, one of the biggest mistakes that a lot of buyers agents do is completely depend on data without, bringing that local knowledge in play, and, overlooking the housing commissions and, buying areas where the rental demand is high and they're just chasing yields, and, the short-term growth might happen because there is a lot of buyer activity due to investors. And Darwin is a typical example, right? Everyone is chasing Darwin right now. And it's interesting, right? Higher yields, never grown in, a previously very volatile market, but there's a lot of investor activity. I think 70% of the buying that is happening right now is basically investor-led activity, right? So it's completely agree with that it's, you need to be really, really careful. And look, using Elizabeth as an example, like I would say 90% of the Elizabeth is still like crime ridden, and you go there and you see wheelie marks on the roads all this while, right? So you need to be really, really careful, even when you're picking out areas of gentrification, looking at housing commissions, looking at areas of opportunities, and balancing out that growth versus cash flow versus longevity of, hey, this is not going to become a meth house in 3 years' time, right?
Yeah. I think what's important with when you're buying like that local knowledge, like, because you need to see, it's not just about sort of the property, but you need to understand the street appeal, because you're buying a property, you need to understand what's next door. Like, you don't want to be buying next door someone who's growing a meth lab, or that you're really, really, really noisy, bad neighbors and stuff. So you need to sort of understand that essentially. So sort of having that that local knowledge, going to the area, getting used to that, and I think that, like you mentioned, like I think as a buyer's agent, you don't want to just be relying on data only, because data can only get you so far, but you really need to you really understand the area. Like I've bought in areas where the street would say, like the housing commission stats says there's no housing commission, but I know there's housing commission in that street just from being there and from speaking to locals, essentially. And if I hadn't been there, I wouldn't have known that there was housing commission there. And it's interesting because sometimes we might be doing something and one of my team are looking at buying a property on that street or nearby, and I say, no, don't touch that street. I got housing commission. And they say, no, it didn't. I looked it up, and I said, no, it's got a housing commission. So, so do you need to actually understand what's really happening in that area?
100%. And you touch, briefly on, dual income properties or duplexes. You see a lot of housing being converted for co-living and class 1Bs, especially in Queensland and Victoria. That's a good way to add a trifecta to the property, especially, if you're buying in blue chip pockets where you know that the property is negatively geared, and, a small change in how the floor plan works and can add amazing results towards the cash flow. What do you think about those?
Yeah, that's a great way to add the trifecta. I mean, that happens a lot in Brisbane, as you just mentioned. Often with having a dwelling upstairs, a dwelling downstairs. One of the things that we do find in Brisbane a bit is that the downstairs is often not legal ceiling heights, so that's something that we need to look into. And I usually advise against buying that, just in case there's ramifications later. But it's it's up to the investor whether they wanted to proceed and do something like that. But often they're reasonably easy to convert. Because you need to obviously get them ticked off and everything, but you need to have separate meters and things in terms of your water and electricity and things. But if you can convert into a house into a dual lock, that can do quite well. Sometimes even buying a house on a reasonably large block that has a good access handle, that you might be able to construct a granny flat in the backyard as dual income. That's definitely a way of adding value as well, although it's a bit more of a longer term process because you're going to go through a bit of a construction phase.
Yeah. And of course, you have built in a multi-million-dollar property portfolio. You're a developer yourself. What is that one deal that has come closest to being the perfect, trifecta?
So I've there's probably a few, but most of them have probably been around the duplex projects in the particularly in the early days when construction was a lot cheaper. But I remember one of the first deals I did was in Newcastle, actually. So speaking back about Newcastle, did a duplex there, and that went really, really well because it ended up getting positive cash flow, from day one. And obviously I'd added that value because I'd built the duplex and subdivided it. But then it had organic growth over the years, which is something that sometimes if you're buying or you're doing a duplex maybe in a more regional market, the growth might be a bit slower, but that went exceptionally well. And probably another one I did one actually in Armidale, which is a regional area in New South Wales. And that was one of the very first ones I did. That was actually when I was still working a previous job as a teacher. And the equity I made in that property was twice what I was earning in a year as a teacher, sort of thing. So that was a substantial amount of instant equity there. And, it was a positive cash flow as well. And that's a property I've still got. So over the time, it's had that capital growth as well. So those sort of deals, I think are pretty close to getting to that trifecta. There's no such thing as a perfect property or anything like that, but those are pretty
awesome. Now, if I try to bring this close for our viewers and listeners, what role does the strategy play in luck versus finding the trifecta? There are people who always sit on the fence line, trying to find that trifecta and spend months and months. I call these, unicorns because, sometimes it's almost impossible to bring all of these three things together. What message do you give to these people?
So I think the first message is, you need to get out and do it rather than just sit on the sideline, because no one's ever created wealth from sitting on the sideline. But what's really important is that you do need to have a strategy and understand what you're trying to do, and never go into an investment unless you understand the investment and what you're getting into, and always ask all the questions. And if you're getting help from a property advisor, then obviously ask those questions, but always get legal advice from your solicitor. Always ask the right questions from that perspective. Strategy is really important to understand what you're trying to do, though. When I first started, I had no strategy. I ended up having about 3 or 4 properties. They were in Sydney, actually, and I was feeling really negatively geared and broke because I had all these properties I was trying to pay for. And then that's when I decided I need to do something different. And that's when I developed my first duplex, and then went on to do some other duplexes and some renovations and things, which, created that equity, which allowed me to, build up my portfolio. And that's when I started to then sort of understand strategy. And then for me over time, I realized that, okay, what do I want to do at the end? What is the end goal? And, for me, setting up something for the family, and having that dream home and things. So I think what I urge everybody to do is have a goal, and understand what that is. So if it's a dream home, if they're looking for to retire or to work part time, they've got kids, they want to pay for private school fees, or they want a certain amount of passive income, whatever that is over the next longer term. So we're talking maybe 10, 15, 20 years. Work backwards from there, and then look at what properties that you need to buy to be able to, to get towards there, and put a good team around you. You need a team, like a financial advisor, accountant, mortgage broker, and things as well.
100%. Yeah. And look, I mean, these are golden words for all the viewers and listeners out there. I think having a good team around you that can support you in every way, shape, or form. I always find that accountant is on a different page, and the mortgage broker is on a different page, and the buyer's agent or a property investment advisor is on a different page, and the financial advisor is on a different page. So it's important that the team works for you and not against each other. And so definitely golden words. Thank you very much, Lloyd, for coming onto the show. Where can people find you, Lloyd?
So the website is lostpropertyprofessionals.com.au.
Thank you very much, Lloyd. And for viewers and listeners, if you have any questions, if you have any comments on, Property Trifecta, have you, prioritized growth over cash flow, or manufacturer returns over growth and cash flow, please share your stories in the comments below. Like and subscribe to our channel. We are Australian Property Academy, or Help Me Buy Property podcast. Thank you for listening to us today. Take care, stay safe, keep smiling, keep investing. This is Moxin Lloyd checking out. Adios.